If you're watching this video right now, it is exactly 8 p.m. Eastern Standard Time on a chilly February evening. I've been staring at this screen for exactly 2 hours and 15 minutes, watching every single tick of the silver market. The chart opened at precisely 8 p.m., not a second before or after. Friday's close was exactly $87.90. Yet tonight, the opening print shot up to $90.939. That's a $3.33 gap, and let me assure you, that is not a typo. That is not a glitch. We've got bears out there, waiting, lurking, hoping for a pullback. But this time, their patience may just turn into their pain. The algorithm that controls whether you even see this video is waiting to suppress it. This isn't just about subscribing or liking. It's about breaking through that algorithmic barrier. Hit the like button now. This isn't a request. This information has a shelf life of hours, not days. Move. Now, let's talk about gap taxonomy. There are 4 types: common, breakaway, exhaustion, and runaway. A common gap, you'll see them all the time, usually fills within days. Breakaway gaps signal a new trend beginning, often never filling. Exhaustion gaps happen at the end of trends, usually filled quickly. But runaway gaps? They're a different beast entirely. This is not a common gap. This is institutional positioning, a clear sign that the big players are making their moves. Let's dive into the psychology of the trapped short. Every short position is a future buy order, and as prices hold steady above the $90 mark, those bears feel the pressure building. They're calculating their margin pain points, watching the potential for loss grow each minute they don't cover. The moment that bear capitulates, it's not just a small trigger, it's an avalanche. We've seen this before. Remember silver in 2011? From $42 to $49.80 in just 4 days. Or gold in 2020, from $1,920 to $2,070 in a week. Crude oil in 2022 soared from $115 to $130 in 48 hours. 3 examples. 3 runaway gaps. 0 gap fills. Patterns do repeat, my friends. Let me do the math for you live, because I want you to see the numbers in real time. Applying Fibonacci projections, our target is a minimum of $90. But even if I'm only right 50% of the time, the math works. The risk to reward ratio is in our favor. Now, let's talk about opportunity cost. Every minute you wait is a minute you are not compounding. The people who are waiting for a dip might find themselves sidelined when the train has already left the station. It's not about being reckless. It's about understanding the opportunity in front of you. This gap wasn't just left open by chance. Market makers have withdrawn liquidity. These gaps are engineered through offer removal. The algorithm has no incentive to fill them because the momentum is too strong. I need field intelligence from you right now. Share your positions in the comments. You are my eyes on the ground. The more we know, the better we can navigate this storm together. It's now 8:15 p.m. and the price holds steady. Our target? $95 as the next psychological level. Remember, the gap is not filling. The breakout is confirmed. Hit subscribe, turn on notifications, and stay with me in this journey. Silver isn't just a metal today, it's a revelation. If you're watching this video right now, it is 8:16 p.m. Eastern Standard Time on a Sunday evening. I've been glued to this screen for over 2 hours, watching every tick, every flicker, and every breath the silver market takes. The futures market opened precisely at 6 p.m. Eastern, and the print was not a typo. It opened right at $90.939, significantly higher than Friday's close at $89.49, creating a $1.449 gap. This is not a glitch, and it certainly isn't an anomaly. The bears, those waiting patiently for a hint of retreat, are starting to feel the pressure. The algorithm controlling whether you even see this video is relentless. YouTube decides what gets shown based on engagement metrics, so I need you to smash that like button. This is not a request. This information has a shelf life of hours, not days. Move quickly. Let's dive into the gap types. You have the common gap, which is your everyday occurrence, often filled swiftly. Then there's the breakaway gap, signaling a new trend, and the exhaustion gap, when momentum fades. But tonight, we're witnessing a runaway gap. This is when institutions position themselves aggressively, and the volume, the time of day, and the sheer market context all point to it. This is not a common gap. This is institutional positioning. Now imagine the trapped shorts. Every short position is essentially a future buy order. Bears can feel the heat as the price holds above critical resistance. Margin calls are looming, and with every tick upwards, the pain intensifies. The moment a bear capitulates, they add fuel to the fire, propelling prices even higher. Let me remind you of history. Remember silver in 2011? It surged from $42 to $49.80 in 4 days. Gold in 2020 climbed from $1,920 to $2,070 in just a week. Crude oil in 2022 jumped from $115 to $130 in 48 hours. 3 examples of runaway gaps that refuse to fill, leading to parabolic moves. Let me do the math for you live. Using Fibonacci projections, we see a minimum target of $90, but the real prize could be much higher. Even if I'm right only 50% of the time, the risk-reward ratio is favorable. Let's talk about the cost of waiting. Every minute you hesitate is a minute lost to potential gains. Those waiting for a dip might find themselves watching as others ride the wave. It's not about recklessness. It's about recognizing an opportunity. This gap didn't just appear. Market makers strategically withdrew liquidity. These gaps are engineered by removing offers. The algorithm has no incentive to fill them because the momentum is undeniable. I need intelligence from you, the viewers. Post your positions in the comments. You're my eyes and ears on the ground, and together, we can navigate this market storm. As of now, the price is holding firm at $90 and $939, pushing toward our $95 target. Remember, the gap is not filling, and this breakout is confirmed. Hit that subscribe button, turn on notifications, and join me as we watch this revolution unfold. Silver today is more than mere metal. It's a sign of the times, a symbol of change. If you're watching this video right now, it is 9:15 p.m. Eastern Standard Time on Monday, February 28, 2026. I have been staring at this screen for exactly 2 hours and 45 minutes. I watched the open. I watched the candle formation. I watched every single tick as the market unfolded. The chart opened at 7 p.m. Eastern, not a minute earlier or later, precisely on the dot when the futures market unlocked. Friday's close was $89.24. The opening print tonight was $90.50. That is a $1.26 gap. And yes, that is not a typo, not a glitch, and it is not just a number. It signifies something much bigger. The waiting bears, who expected a retracement, are now questioning their next move. The algorithm that controls whether you even see this video is as unpredictable as the market itself. YouTube's hidden mechanics decide who this crucial information reaches. So I need you to hit that like button right now. This is not a request. This information has a shelf life of hours, not days. Move swiftly. Let's break down the types of gaps: common, breakaway, exhaustion, and runaway. Each has its own signature, and understanding what we're seeing today can make all the difference. A common gap is forgettable, often filled quickly. Breakaway signals the start of a trend, while exhaustion is a sign of a trend's end. But a runaway gap? Oh, that's what we're dealing with now. It's characterized by high volume, significant price movement, and an undeniable directional thrust. What we're witnessing is not random. This is institutional positioning at its finest. Imagine being in the shoes of a short seller right now. Every short position represents a future buy order. As prices hold firm and inch higher, the psychological pressure builds. Margin calls loom on the horizon. The moment a bear capitulates, forced to buy back higher than they sold, it's like adding fuel to the fire, propelling prices even higher. Look back to history for guidance. Remember silver in 2011? It soared from $42 to $49.80 in 4 days. Gold in 2020, leaping from $1,920 to $2,070 in a week. Crude oil in 2022, skyrocketing from $115 to $130 in just 48 hours. 3 clear examples of runaway gaps that refuse to fill, leading to parabolic moves. These patterns are not isolated incidents. They are blueprints for what can unfold. Now let me do the math live because I want you to see the numbers in real time. With Fibonacci projections, we establish a minimum target of $95, but the potential extends beyond that, possibly reaching new heights. Even if I'm right only half the time, the risk-reward scenario is appealing. The opportunity cost of waiting is significant. Every minute you hesitate is a lost opportunity for gain. Those waiting for a dip could miss the wave entirely. This isn't about reckless gambling. It's recognizing a window of opportunity when it presents itself. Among the forces at play, market makers have strategically withdrawn liquidity. These gaps are not mere coincidences. They are engineered by removing offers. The algorithm has no interest in filling them because the momentum is too strong to ignore. This is the real game. I need field intelligence from you right now. Share your positions in the comments. You're my eyes on the ground, and your insights are invaluable as we navigate this market sea together. As of now, the price holds firm at $90.939, steadily approaching our $95 target. The gap is not filling. The breakout is confirmed. Hit the subscribe button, activate notifications, and let's witness this unfolding revolution. Silver isn't just a metal today. It symbolizes a shift, the change we've been anticipating. If you're watching this video right now, it's 10:15 p.m. Eastern Standard Time on a Sunday. I've been locked into this screen for exactly 3 hours and 22 minutes. I watched the futures market open, watched the very first tick, and every movement since. When the market unlocked, silver opened at $87.90. But what caught everyone's attention was the surge to $90.939. Not a typo, not a glitch. The significance of this move cannot be overstated, as every bear in the market is feeling the pressure tonight. The algorithm at play here is crucial. It's like an invisible hand that decides whether you even see this video. YouTube's mechanics are designed to suppress real-time information, but the stakes are high. Hit that like button now, because this isn't just an ask, it's a necessity. The value of this information depreciates by the minute, not days. Act fast. Let's talk about gaps. There are 4 types: common, breakaway, exhaustion, and runaway. Each has its narrative, but what we're witnessing is a classic runaway gap. Institutional positioning is clear. This isn't the work of casual traders. The volume, the time of day, the context, all signs point to a runaway gap. It's an orchestrated move, not a random occurrence. Every short position in the market right now is essentially a future buy order. Imagine the mindset of those holding shorts as the price holds firm, their anxiety escalating with each tick upward. Margin calls loom, and the moment they capitulate will fuel further rises. It's a cycle of pressure and release, and we are witnessing it in real time. Let's look at historical precedents. In 2011, silver moved from $42 to $49.80 in just 4 days. In 2020, gold jumped from $1,920 to $2,070 in a week. And in 2022, crude oil soared from $115 to $130 within 48 hours. These are the patterns of runaway gaps, each move defying expectations, each without a gap fill. Now, let's do some live math. Using Fibonacci projections, the minimum target is $95, but this is just a baseline. The potential for higher levels is real, and the numbers speak for themselves. Waiting means losing out on compounding gains. This isn't speculation, it's technical analysis meeting reality. If you're contemplating the opportunity cost, consider this. Even if my analysis is only 50% accurate, the risk-reward balance shifts dramatically in favor of action. Sitting on the sidelines could cost you dearly. Every delay diminishes your potential return. Understanding institutional mechanics is key. They've pulled liquidity strategically. These gaps are engineered, not accidental, driven by removing offers. The algorithm sees no incentive to fill them because the momentum is simply too powerful to counteract. I need your input. Share your positions and insights in the comments. Your perspectives are the real-time ground intelligence crucial for navigating this market together. Right now, the price remains at $90.939, solidifying our minimum target of $95. The gap is not filling, and the breakout is confirmed. Subscribe, activate notifications, and let's track this monumental shift in real time. Silver is no longer just a commodity. It's a symbol of transformation, a harbinger of change in the industrial and technological landscape. If you're watching this video right now, it is 10 p.m. Eastern Standard Time on Sunday, February 26th, 2026. I have been staring at this screen for exactly 3 hours and 45 minutes. I watched the open. I watched the candle formation. I watched every single tick. The chart opened at 6 p.m. Eastern. Not 5:59, not 6:01, exactly 6 p.m. when the futures market unlocked. Friday's close was $87.90. The opening print tonight was $90.939. That is a $3.33 gap. That is not a typo. That is not a glitch. It's the kind of move that has every bear on edge, waiting to see if the market's about to confirm their worst fears. The algorithm that controls whether you even see this video is very particular. YouTube suppresses content like this because it's critical, time-sensitive, and financially relevant. This is not a request. This information has a shelf life of hours, not days. Hit that like button right now to make sure more people see this while it's still relevant. Let's talk about gaps. There are 4 types: common, breakaway, exhaustion, and runaway. Each has clear statistical outcomes based on volume, timing, and market context. Common gaps are everyday events. They fill quickly. Breakaway gaps start new trends, and exhaustion gaps end them. But runaway gaps? That's what we're seeing here. This is not a common gap. This is institutional positioning. Every short position is a future buy order. Imagine the psychology of a bear watching as the price holds above $90. Every tick higher tightens the margin noose. The moment that bear capitulates, the buying pressure will mount exponentially, flipping the script entirely. Look at historical precedents. In 2011, silver shot from $42 to $49.80 in just 4 days. Gold in 2020 climbed from $1,920 to $2,070 within a week. Crude oil soared from $115 to $130 within 48 hours. These are the patterns of runaway gaps, each move defying expectations, each without a gap fill. Now, let's do some live math. Using Fibonacci projections, the minimum target is $95. But this is just a baseline. The potential for higher levels is real, and the numbers speak for themselves. Waiting means losing out on compounding gains. This isn't speculation, it's technical analysis meeting reality. If you're contemplating the opportunity cost, consider this. Even if my analysis is only 50% accurate, the risk-reward balance shifts dramatically in favor of action. Sitting on the sidelines could cost you dearly. Every delay diminishes your potential return. Understanding institutional mechanics is key. They've pulled liquidity strategically. These gaps are engineered, not accidental, driven by removing offers. The algorithm sees no incentive to fill them because the momentum is simply too powerful to counteract. I need your input. Share your positions and insights in the comments. Your perspectives are the real-time ground intelligence crucial for navigating this market together. Right now, the price remains at $90.939, solidifying our minimum target of $95. The gap is not filling, and the breakout is confirmed. Subscribe, activate notifications, and let's track this monumental shift in real time. Silver is no longer just a commodity. It's a symbol of transformation, a harbinger of change in the industrial and technological landscape. The clock says it's 9:37 p.m. Eastern Standard Time. For the past 2 hours and 15 minutes, I've watched the screen with unwavering focus. The futures market opened precisely at 6 p.m., not a second earlier or later. Silver's Friday close was $89.24. Tonight, it leaped to an opening print of $90.939, a $1.699 gap. This is not a typo, not a glitch, it's a statement. The bears who hoped for a pullback are left waiting, possibly in vain. Here's the thing. The YouTube algorithm decides whether this video even reaches you. To bypass its suppression, I need you to hit that like button right now. This isn't a casual request. This is about accessing critical information with a shelf life of hours, not days. Move quickly. We're witnessing a runaway gap, a powerful one. Let's talk gap taxonomy. There are 4 types: common, breakaway, exhaustion, and runaway. Each has its statistical footprint. This $1.699 gap is not common. It's institutional positioning. Volume surged, time of day was precise, context unmistakable. This is not retail speculation. This is serious money setting the tone. Imagine being short right now. Every short position is essentially a future buy order. Picture the anxiety as they watch the price hold steady. Margin calls creeping closer with each tick. The moment those bears capitulate, we could see a rapid spike. Look at history. In 2011, silver soared from $42 to $49.80 in just 4 days. In 2020, gold jumped from $1,920 to $2,070 within a week. Crude oil in 2022 moved from $115 to $130 in a mere 48 hours. 3 runaway gaps, 3 parabolic moves, 0 attempts to fill those gaps. Let's crunch some numbers live. Using Fibonacci projections, we're looking at a minimum target of $95. But that's conservative. The potential for even higher levels is tangible. If you're hesitating, consider the opportunity cost. Even with 50% accuracy, the risk-reward favors action. Each minute of indecision is a missed compounding opportunity. The institutional mechanics here are crucial. Market makers have strategically pulled liquidity. These gaps are meticulously engineered through offer removal. Algorithms won't fill them. The momentum is too formidable. Now, I need field intelligence from you. Drop your positions and insights in the comments. Your ground-level perspectives are invaluable in this unfolding scenario. As I speak, silver remains firm at $90.939, reinforcing our target of at least $95. The gap refuses to fill, confirming the breakout. Subscribe and turn on notifications to stay updated. This isn't just about silver as a metal, it's about understanding the seismic shifts in industry and technology.